Welcome. This is What You Need to Know, and we are in conversation with economist and founder of Makwe Fund Managers, talking investment and trading. Masilela, welcome. When we talk investment, what are we talking about?
Investments, we are talking, number one, the principle of putting your money away in such a way that it should be able to earn you some returns after a certain period of time. Having said that, it tells you that you can have an investment for a year, 3 months, 6 months, 12 months, whatever period. At the same time, it tells you that whatever returns, whether you call them a yield or you call it an interest, but at the end of the day is what you are earning above what you have put in. It will vary depending on the investment product, whether it's going to be 2%, 3%, or capital guarantee, whatever it is. And it also now tells you that there is this whole thing of the higher the risk, the higher the reward. Hence, it's important to also consider the risk-reward ratio of this whole thing.
Having mentioned the risk that is involved in investment, now I've checked your fund. You have about 3 different types. Well, I saw 3 different types. If there's more, you can elaborate. So I just want to understand the difference, especially when it comes to risk.
Yes, our investments are purely buying shares on the Johannesburg Stock Exchange. And now that investment has got number one risk in the sense that all the risks that are inherent in owning a share, like should that company go down, you'll be the last person to be rewarded, stuff like that, and they have that, number one. Number two, you should be looking at a long term because you're talking shares, because they fluctuate. Long term book definition is anything more than 2 years. Though we're not going to tell you that you must put your money away for 2 years, 3 years, or 4 years, or 5 years. But you should bear that in mind. And thirdly, it tells you that you must first cover your basics before you come and buy shares. It doesn't help that you give us the money to buy shares and then all to find that you cannot meet your monthly expenses. Now, we've got 3 kinds of portfolios. We've got a consecutive portfolio, meaning you don't take much of a risk. You buy the kind of companies that you know that are very big and stable, and at the same time, they can pay you a dividend. And then that is why we are saying that will also be best for someone who's much older, stuff like that. And then thereafter, you have what we call a growth. The growth is usually for the young ones because now there you are happy to take a risk about buying shares in companies which don't have that good track record as yet. There are more of startups. So you are able to take that kind of a risk because should things not work out, you still have time on your side, given your age, that you can still come back. Then we have the middle one, which is balanced. That's between the first and the second one. That is more of a balanced thing more than anything else. So all of the 3, they have a common risk that you are buying shares, as we said, that you are owning a share of a particular company, and should something happen to that company, you as the owner, you'll be the last person to be rewarded.
Okay, so how does that work? I mean, sometimes they will tell you, okay, so you're looking at 10% increase within the next 2 years or within a year. How does that work?
You know, we've, I think, talking investments generally, you can get that kind of an investment. Say you go to a bank, they tell you that will give you 8.5% return per annum. You know, if you go maybe to some of the insurance products, they can tell you that will give you maybe 9% per annum. But now, when you come to the likes of us buying shares on the Johannesburg Stock Exchange, no one can tell you how much are you going to earn. After a certain period of time, they'll be misleading you. Reason being, take an example. Just here on Monday, we just saw the share price of Pick n Pay going down by 15%. And all because they gave us the bad sets of results and they fired their CEO. No one expected that to happen. And we are saying that because in July, the very same company told us that they don't expect a loss. But here they are, 2 months down the line, they're telling us there's a loss. So I'm using that as an example to say you cannot actually predict how a share price will perform. You will know that given 1, 2, 3, 4, 5, this company should do well, but that well, you cannot work out that it will go up by 10%, 15%, or 20%. Hence, it will be wrong to tell people that after a year we'll give you 5% or 10% or 15%. And the JSE as well doesn't allow us to use past performance, because that's misleading. And whatever I tell you that you will earn, then I should be able to prove that. If I say you'll get 20%, then let me prove it to you. With shares, you cannot prove that. But other form of investments, it's easy for them to say, we'll give you 8%, in a year's time. And it's easy to get that. But now, the risk-reward kind of a thing, that's less risk with that kind of investment. Hence, the rewards are small, it's 8%. But here when we buy shares, stuff like that, the risks are high, hence you are able to either get 20%, 30%, 100%. You can even make more than that in a period of a year or in a period of 2 years. What I'm saying, the risks are high, hence the rewards are also high.
So I want to understand. So sometimes people want to do that themselves and without using a company like yours. How does that work? Is that a possibility? And if one has to do that, what now do they have to look at to be able to make money?
You won't be able to buy shares yourself. You still need to get someone who's been authorized by the Johannesburg Stock Exchange. Same applies to in that very particular company. Not everyone is allowed to buy shares. That person must be registered and have a license from the JSE, so that the JSE, they know exactly who they deal with. So the company must be registered, the individuals must be registered. Other companies might not be registered with the JSE, but registered with the FSCA, which is very important. And I think maybe that's what we should have mentioned at the beginning, that in this country, the minute you talk to someone about money, make sure that that person is either registered with the Johannesburg Stock Exchange or with the FSCA. Other people know it as the Financial Services Board. If that person doesn't have a registration number, please by all means don't deal with them. So now how it works is that companies have different systems. We've got a trading platform that we allow people to invest from as little as 50 Rand per month. It's an app that you download. It's called Root Trading. Then on that app, you can either buy shares yourself, or we buy it for you, or a combination. We manage it, but you just give us an instruction electronically when we say you are trading yourself. So whatever you trade from the platform or even from your bank online trading services, that instruction doesn't go to the JSE, it goes to your bank. And then your bank takes that, and they're the ones that send it to the JSE, because they need to know from the JSE side who are they dealing with. The JSE doesn't know you, so it's just you are giving instructions electronically. Basically, you are not like trading, but it's quick and efficient, because the price that you see, you are able to get that. So that's important. So you cannot trade directly with the JSE, but you can have an account without having a third party. A third party, you'll still need your bank, you'll still need us to open an account for you. So it just makes you look smart, but actually all you are doing things electronically, because before people were doing things over the phone, calling you, talking to clients, so they just eliminated that part. You just send that instruction or message electronically. So you will always need someone who's registered with the FSCA or with the JSE to be able to deal with money in this country.
If I want to know which one is correct for me, I mean, I might be a middle-aged person. I'm not too old, I'm not too young, but I don't want to lose money that much. What advice would you give such a person?
It's very important that your portfolio manager do what they call a risk assessment. There are questions that will ask you to determine your risk, and that risk we score it, then it will tell us where you fall. But you as a client, you've got the right to override it. If he says you must go growth, given the risk profile, you give the right to say, no, I don't want growth, I want balanced. But to get to that, we do a risk assessment. There are some standardized questions that we'll ask you, and then we mark you.
There's this thing they call a passive investor and an active investor. Can you please explain the difference?
Passive investment is like you don't actively select stocks. You can go and buy the market to say, I'm buying the JSE, that's got the price so that, or I'm buying the financial stocks. All these financial companies, then they lumber them, then they make one price for you. You know, they call that exchange traded funds. So you don't have to actively pick one company over the other. Active management, you go out there and do research. You number one thing that which sector will do better, and from that sector which companies will do better. So you actively research them and manage them, and then you'll always actively monitor them to see their performance, because remember, whatever you bought, you are able to sell it either the very same day, after a month, or whenever you want to sell it. You are not married to that particular stock. So passive is like, I'm buying the resources. I don't care whether it's platinum, it's gold, it's whatever. And out of the gold shares, I don't mind. I don't have to decide which gold mining company I must buy. So it's a resources index. So passive mainly talks to the index, and then hence people know the likes of your Citrix, because that's what they do.
Does that make you money, being a passive investor? Does it give you the rewards that you would want as an investor?
It does, and all of them, the question is the returns. Because remember, you didn't do a lot of research, you didn't do a lot of work, and if, say, the resources index goes up, then you're also making money. And somebody who might have been active might have picked up a wrong stock, or to find that it goes down. The disadvantage as well when it comes to active is that I can pick up a wrong stock and all to find that it goes down, or the right one, it goes up. Passive, it means that the heavyweight, the big companies might go down, all to find that in that index does not mean every stock went down. But overall, because we've got big companies in that index, because they're down, then it takes the whole thing down. But we might find that we've got small, medium ones which went up. So they all have their advantage and disadvantages. And do they all make money? Yes, they all make money. Do they all lose money? Yes, they do all lose money.
With the apps, you mentioned that you guys have an app. With the apps, I would see that there's a chart that would show you where the markets are and what's happening, whether it's going up or down. How do we cap? Say you have invested a certain amount of money. Now you are looking at this one, it looks like it's going to go down.
I think you have to have sort of a target in your mind that I'm happy to take losses up until maybe say 5%. If my losses gets to be less than 5% or whatever percent, what we call the stop loss, then you are selling. Others are happy to even take losses up until 50%. Because remember, with shares, if the price goes down, you bought a share at 10 Rand and it goes down to 7 Rand, you made a paper loss of 3 Rands. Up until you sell at 7 Rand, then that's only when it becomes an actual loss. Just like when you bought it at 10 Rands and it goes to 15 Rands, you made a paper gain of 5 Rand. Up until you sell at 15, then that's an actual gain of 5 Rands. So a stop loss as well. Others will say, okay, it's fine, it will come back. They leave the shares. Others, they don't maybe have the nerves and say, no, 10% down, I'm out. Same principle applies when it comes to your profits. You don't have to be greedy. You should be saying at a certain point, I'm happy with a 20% return that I made. I'm happy with a 7% return that I've made. But the wise thing as well on the profit side, make sure that you've factored in your costs so that you can really see the actual profit. So it's up to you that, but usually people, they tend to be greedy and think it will go more and more up, or to find that, oops, it managed to hit the peak, is coming down. So I think it's something that you as an investor should have in mind, or you leave that to the professionals to do it for you.
How do we monitor the markets? I mean, if somebody wants to do it online and they want to always be there. I've heard someone say that you have to be there every hour. You need to be checking your stock. If I say I want to stop it at this point and I still have to go through someone else to do the sale for me, does that really benefit, or work towards what I want to happen? Say, does it stop it at the moment, at the very same time? If this person is dealing with how many people, and I want it stopping there.
It's very efficient. It will stop there. If you send an instruction that I want to sell at 5 rand, then they will sell at 5 rand. If it's not yet at 5 rand, they will wait for it to get there. And if maybe they can see that that price that you are asking for is not going to happen, they have to let you know that we don't think you'll get it at price. Because remember, whatever you are looking for does not necessarily mean you'll get it. It depends on other market participants. But normally you get it, and then it might not be same time, but ultimately you can get and can give people instructions that I only want to buy that share when it's at 15 rands. If it doesn't go down to 15 rands, I'm not buying. That's an instruction they will wait. I want to sell when this thing maybe hits X amount. Then they will be able to put in your order and wait up until it hits that amount. It's very, it all happens quickly within seconds. And I think maybe that's the advantage of giving the electronic instructions compared to the old way of picking up a phone, talking to someone. It takes forever. You are entertaining one person for 7 minutes. So you are not being that effective compared to if those things come electronically. So yes, you will be able to get their hands. Trading and investing and portfolio management, you get people who are doing it as a job, as a career, full time, because they're watching the screens. You as an individual, like a customer, you've got your job somewhere, so you don't have the time to be watching the markets the way we're watching the markets. But we'll send you a message to say, hey, listen, we think you must sell or buy, but we're not sure when are you going to read that message. Remember, why we're watching the screens every time is because markets get to be moved by news, whether it's international, political, social, whatever news, they move the companies. And companies as well gets to be moved by their own specific company news. And because we own those shares, you are a shareholder, I'm the owner of the company, whatever happens at the company, they first have to inform us. So one of the screens that we are watching there is called the Stock Exchange News Services. So those companies are required by JSE to inform us that, Pick n Pay did this, Sasol did that and that, then we act on the news. And for market efficiency and to avoid insider trading, you have to give information to all the participants at the same time. The question will be, how do they interpret that information?
If I want to start investing or trading and I don't know anything about that space, what do I need to do to make sure that I make the right decisions and I get the right companies or portfolios?
It's like if you're going to court, or you've got a matter, you'll go and look for a lawyer because they're professionals, they're trained in that. You are sick, you'll go to a doctor, he's trained in that, With investing as well, you then have to go to a professional. Then they will do all the job for you. But they've opened up an opportunity for you to do it yourself if you want to. And usually people have two kind of accounts where they play with a small amount themselves, but the bigger part of the investment is done by professionals.
That's where the 50 Rand comes in with your...
Exactly. You have 50 Rand per month, stuff like thing. That's where it comes in. Then you can play on your phone, on your board, stuff like that. But your life savings, stuff like that, then you have to give that to a professional.
Tata Masilela, we are very grateful for your time. Thank you very much. And that was economist and founder of Makwe Fund Managers talking to us about investing and trading. And that's it from me. Until we meet again, stay blessed. Remember to like, subscribe, and share.